Hi, I'm Ronahine Hartman. Welcome to Funds TV. I'm here today with Frank Schramm. Frank is the co-CEO of BBGI, which is a London-listed infrastructure fund. And actually what's quite interesting about this business is that they're investing or co-investing in areas of infrastructure which are social infrastructure that impacts all of us. So it's our hospitals, it's our schools, it's our roads.
Infrastructure is a relatively young asset class, so it emerged in the mid-90s era and the beginning of the 2000s when the first infrastructure funds or investments appeared. And in principle you can divide infrastructure into economic infrastructure on the one hand and social infrastructure on the other hand. Economic infrastructure are ports, airports, transmission lines in water, gas, electricity, and power plants in principle. Social infrastructure on the other hand is more like, you mentioned schools, you mentioned education, so schools, hospitals, roads and prisons, and it has got more an impact, direct impact on society. In terms of top 5 facts, infrastructure is always long-term. If you think about the nature, you typically talk about a horizon of 25 years plus. And what's also interesting is you've got long-term, stable, predictable cash flows. So the income from these areas is predictable, and that's what makes appealing to certain types of investors. They like that, and it's independent from economic cycles. So if equity markets go up or down, infrastructure is not very much affected. There's a very low correlation to equity markets and other markets. And that's also quite an appealing point. And it's inflation protection. You've got some sort of inflation mechanism there where it's indexed the revenues, and that actually is also important for a number of investors where they have got long-term obligations to pay out. And last but also very important is it has an impact on the society. If you've got good infrastructure, social infrastructure around you, people are attracted to that region or actually to the cities itself.
Fantastic. That's a really good introduction. So I think that one of the things that always interested me about BBGI as a business is that you're really the link between the infrastructure part on the social level and the business end, so the investment part as well.
Yeah.
Can you explain a bit more to us just about BBGI and how the business works?
Yeah. Maybe interesting fact is, what we call an infrastructure fund, or investment company, we are a listed company. We're listed, everyone can buy our shares and look it up, and we've got annual reports on the London Stock Exchange. So we're listed in 2011. We currently got a market capitalization of about 560 million, or in euro terms over 700 million euro. We have got a global portfolio of 39 infrastructure investments in PPP, in public-private partnership. And maybe briefly, what's PPP? PPP is where a public sector entity contracts with the private sector, and that private sector entity, typically a project company, builds, operates, finances, and an infrastructure asset, often a school or a hospital or a prison or a road.
That's interesting. I'd like to pick up on that a bit more if that's okay. So one of the things that people will be watching, will be thinking, why would the government decide to go into a business deal with a kind of private sector company? What's the benefit actually for the people sort of watching this to understand?
Often the government, so there's two procurement methods. There's traditional procurement where the government goes out and actually makes a bidding process and hires a contractor to build something. Then he hires an FM operator to actually make the facility management, or delivers it themselves, and then he looks at life cycle with a third contractor. And often what happens is these assets or this project is not delivered on time and on budget. We always hear about the stories that are a very prominent example in Germany, for example, is Berlin Airport. Berlin Airport was supposed to be finished in December 11 for an estimated cost of 2.5 billion. Now 4.5 years later, we're still quite a bit away from actually finishing it, and the costs are now at 6 billion and likely to go up to 8 billion. So what a PPP project does is, you got a fixed price, date certain contract with a private sector entity, and if they don't deliver that on time and on budget, they take the risk. So they take the burden. So their cost overrun, they have to pay it. If there's time overrun, they not get compensated for that. So they take the risk for that. and it's a key deliverable, and it's a vast majority of PPP projects actually delivered on time and on budget. The second big advantage of that is, for the public side, is you introduce technology, private sector technology and innovation into public sector. And with that, not always, but often, you can achieve operational efficiencies.
Even more so.
Yeah, so. And when you talk to the clients, to the public clients, they're very happy with the services delivered. They like it. They like the facility, they like the service. Yeah? And if they're not happy, they can make deductions. So that means, you know, they deduct money from the so-called fee or availability payment, you know, if there are poor performances. So they always have got a stake, yeah, in case of poor performance. And that is a motivation, you know, of the private side to deliver high quality and high performance.
That's really fantastic to hear. I think that a lot of people probably watching this will be pleased to hear that there is a way for these projects to be managed, you know, more efficiently. And I think that, you know, it's one of those great misunderstandings that people perhaps aren't aware of, that there are so many benefits to do with, you know, this combination between the public sector and the private sector. Interesting to understand a bit more from you about the type of investments that BBGI is currently involved with, so that people watching this can maybe understand how it will impact them.
Sure. I mentioned before we invest in social infrastructure, and social infrastructure is schools, hospitals, prisons and roads predominantly. So we have got about 34 different school facilities which provide a safe learning environment for over 35,000 students, mainly in Germany and in the UK. We also have got 36 hospitals or medical centres in the UK, in Canada and in Australia, and they actually treat or provide services to 1.2 million patients. Important to say is we don't provide wide service or don't provide direct educational service like teachers, but we provide the facilities and everything which comes with it, canteen services, yeah, sometimes laundry services in the hospitals. Yeah. And in terms of roads, we actually operate 10 roads, yeah, and I've got more than 1,250 lane kilometers where we actually provide good passenger services. There are good services that the roads are open, cleared. If there's snow, it's actually cleared very, very timely, and if there's accident, that's cleared. So that's the responsibilities we are taking over.
So you're also involved in helping people to get around at Christmas periods. Your team are kind of involved with all of that, so that's good to know. So let's talk a bit more about your team then. So what's interesting about your business is that you actually have the asset management team in-house. What type of value add do you think that brings?
Yeah, we're different from many others in the market. We are not a fund manager or an external fund manager. All of our staff, including myself, are employed by the company BBGI itself. So we internally managed. That means we have got asset management internally, we have got financial management internally, and all the other corporate services. So we are also active manager in the sense of we actually participate in all board meetings. All staff, including myself, actually, the directors on these different investments here, on the road companies, on the hospital companies, on the schools companies, and we have regular meetings, and we do active hands-on management, are involved into that management on a quarterly or even monthly basis.
And how does that impact the running of those sort of assets?
I think the running of the assets, first of all, the running of the assets is, if you're hands-on, you know about the issues firsthand, and you can react fast. You not have to go through different layers, which can happen if you organize that differently. And the impact for the investor is that we have got very low cost. We're not actually charging a fee to an asset manager or asset under management, because we're not an asset manager. As an external asset manager, we do everything in-house. Our people, directors, asset management, are employed by the company, and providing the services directly for the company, but all to the different project companies which invest in the hospitals, schools, or on the roads.
Yeah, I think that's an interesting value add, because you're sort of sitting in between the two, but essentially providing quite a unique service to both the investor side and actually the society side, which will benefit from the assets. I think that there was traditionally a very negative view painted of public or private combination projects, but actually we have fantastic people working in the private sector, and it's great if we can get them more involved in working with us in the public sector, because it really adds a lot of energy to the game, really. So let's talk a bit more about how the investment side is connected and how infrastructure funds typically differ from other asset type of funds.
Yes. As mentioned, infrastructure as an asset class emerged late 90s, beginning of the 2000s, yeah? And they're not less long around as, for example, real estate or equity funds or debt funds. Yeah? But in the history of now almost, let's say, 20 years, yeah, they've shown a couple of characteristics which are very unique. Yeah? They are not like equity funds having got or targeting high returns, yeah, or like debt funds or real estate funds low returns. We're in the middle between real estate and debt funds and equity funds on the other hand. So we target an IRR or return between 7 and 8% and want to pay 6 pence dividends per year for a share. In the first 4 years we have now been operating, we have achieved a total share return over the 4 years of 53% and an annual growth rate of 12%, which exceeds our expectations or our targets which we have to the market. That was very well received. The second difference is what investor type do we actually target? You know, what is appealing to this asset class? And it's appealing to insurance companies and pension funds. Why is it? Because insurance companies and pension funds typically have long-term obligations and to pay out pensioners or to pay out insurance money, you know, and they need to have got long-term income, you know, which is stable and predictable and inflation protection. So that's the reason why we've got a lot of pension funds or insurance companies interested in that asset class, but also people who are simply looking for yield. Given the low interest environment, simply looking for yield, which have got some sort of inflation protection. That's also the second investor class, which is where the asset class is appealing to. And the last point is it's a long-term nature. You know, long-term nature and government. We actually contract with government or government bodies, where private equity or debt funds or real estate have got often very typical corporates. Mm-hmm. We have got AAA and AA rated counterparties. Mm-hmm. So that adds to the long-term and secure cash flows.
Great, thank you very much, Frank. I think it's been a really interesting talk today. And obviously, anybody watching this who has any questions, please email us in and we'll directly connect you with Frank. Thanks.
Thank you, Rana.